This is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. Glad you could join us here for Market Minutes, conversation about the market. Today is July 13th, 2020, and glad you're with us. Please see our disclaimer for important information. So in our commentary this week, we really have a couple of things on the front burner. Obviously, we've got earnings reports for the second quarter, which are literally on top of us right now, and we'll get those for the next 3 weeks. We're going to be listening for a lot of inflection in the voice of management. We're going to be listening to obviously the data that's being reported for the second quarter. We're going to be listening for things that companies are doing to try to prepare themselves for the unknown. And we know that there's, certainly the risk of the second wave in concert with the typical flu season. So, no doubt we've had a bit of an uneven open with some of the Sun Belt states even kind of retrenching. So, and then on top of that, as if we didn't have anything else to deal with, we've got a presidential election in which a lot of the issues incumbent with this pandemic are being politicized very unfortunately. But there's a lot of information on the limited breadth in the market that we've been talking about that are in charts of the week. And we also have some data related to COVID-19, which I would urge you to take a look at, coming to us from our friends at First Trust that done a lot of compilation from the various COVID data collection efforts that are out there. But let's get into the meat of what's going on in the market this week. So last week, stocks extended their gains. The S&P was up about 1.76, and it's now just down about 1.4% for the year. So really battled back. So despite the COVID-19 backdrop, we've had a fairly strong response in the market. Year to date, as I mentioned, the S&P's only down 1.4%. The Dow Jones, which doesn't have as much of the benefit from technology stocks, is down about 8.6% year to date. Although for the month to date, both are up positive. Now the NASDAQ, which is obviously very heavily laden with technology, is up 18%, and the Russell 2000, which is more small cap related and has more small cap exposure, was the only one of those major indices that was down for the month and is down over almost 15% for the year. International stocks up 1.6 for the month and down about 11%. That's the MSCI EAFE index. Bonds have been positive on most fronts. The Barclays aggregate, which is extremely price sensitive to changes in interest rates. As rates have fallen, that index is up about 6.7% for the year. Meanwhile, high yield and leveraged loans are down anywhere between about 3 and 4% roughly for the year. Real estate, obviously, with a lot of non-payers out there, forbearances on leases and things like that. Real estate's down about 14% for the year. We know energy's down quite a bit, and hedge funds are down about 4.4%. Crude itself is down about 34%, but gold is the shining star in all of this. Gold is up slightly for the month, so lagged stocks for the month, but for the year it's up 18.3%, as is the U.S. dollar. And so the S&P, for its part, is actually within roughly 5 points that it was where it was a month ago. Volatility has picked up, and it's at a point that's kind of in that top 10% of historical volatility numbers that we've seen. But we're seeing some movement on noise, and days that we get good vaccine news, we typically get a positive response, and bad days when we get caseload announcements that we've been setting several records in some of those Sun Belt states here lately. But again, as we transition into the second quarter earnings season, The consensus estimate calls for a 12% drop year over year in revenue and a 44% drop in earnings. And that earnings drop is translating into, what we've been talking about is higher multiples, higher trading multiples. So there's the valuations have really gone up as of late because of this precipitous drop in earnings. And again, I want to caution everybody by saying that that's not atypical. When you come out of a recession or when you're transitioning from certain phases within a recession, that you typically will see high multiples. So, right now there's a lot of unknowns. Again, that sounds like a broken record from other previous weeks, but analysts are making a lot of different assumptions in their models. We don't know exactly, what to model at this point related to wave 2 or vaccines or things like that. But lately we've had a lot of surprises on the upside, and we don't know if that's going to translate into earnings. And what the typical trend for earnings is, that there's a majority of firms that will beat on revenue and earnings when they report. And so the hope, and I guess to some degree the expectation, is that that's going to play out again this quarter. But we definitely need earnings to respond here so that we can continue at least the steam or the wind that's behind the sail of this market right now. And obviously we'll need some greater clarity. We'll need a tempering in some of the caseload data, and then we'll need to see at least a reversal in some of the tempering of the high frequency items that we've seen. Travel data from TSA, restaurant. Again, we have a chart about restaurant activity in our charts of the week. Urge you to take a look at that. But when we have a tempering in some of that right now, and if we can get back to that uptrend, obviously dovetailing with a positive or at least encouraging earnings forecast, that would certainly be good. We've talked about the breadth in the market. NASDAQ is up tremendously this year, as we've said. There's a couple of charts in charts of the week that talk about this point. I mean, we have basically 6 stocks which account for 26+% of the market, and if you take just the growth element or the growth component of the Russell 1000 index, Apple, Microsoft, and Amazon are almost 29% of that, and tech itself is 28% of the S&P 500. And in the meantime, other sectors, kind of the old economy, if you will, materials, utilities, they're down like 2.5 to 3% weight in the index. And so, this is really becoming technology dominated. So, it's interesting that we've had, some of these areas that just aren't as relevant as they used to be. With that, talking about fixed income, interesting this last week, the 10-year Treasury hit a 2-month low of 57 basis points. That's 0.57% last week. And the 5-year Treasury fell to a record low of 26 basis points, or 0.26%. Now, we know the Fed is very, very interested and motivated to avoid negative interest rates. But there's a lot of downward pressure, and they've said that they're going to maintain low rates for an extended period of time. So we certainly don't expect a lot of positive news for savers on the yield front for the time being. Crude continues to kind of hold around $40 a barrel. And on the economic front last week, on the ISM, the Institute for Supply Management, non-manufacturing, their service index, which is the majority of the economy, it rebounded sharply in June to 57.1. It just totally hammered the consensus, which was much lower, and 57 is clearly in expansion territory. But that's been offset by, like I said, some of these high frequency items like TSA checkpoint counts and restaurant activity. Producer prices, again, on the inflation front, we're not sounding the all alarm, because I really do think that, the intermediate to longer term issues are going to be more inflation. Right now, there's deflationary impulses, and that producer price number for the June reading was actually down 0.2%, when that consensus number was actually calling for a positive gain. But we've talked about, we talked about employment a little bit in charts of the week, but just suffice it to say that we have continued to see lower unemployment claims relative to what we certainly saw in April. They've kind of leveled off. They were 1.3 million for the last week. That's far lower than roughly the 7 million from mid-March, but it's still much higher than what we saw on a trend line basis prior to the pandemic. And the important thing in all this, continuing claims is still 18 million. So we still have a lot of people that are drawing this, at least continuing to claim unemployment benefits, which brings me to the next point, that we have some events we're on the eve of some significant events that, if Congress doesn't address this, it's going to be on our doorstep that we're going to have to deal with. So obviously we have the $600 supplemental employment compensation benefit, which is set to expire at the end of this week, end of this month. And so there's a move afoot by members of Congress to extend that and over perhaps another 3 months, but with triggers. So when state average unemployment rate drops below a certain point, then some of that stimulus goes away. And there's also a move afoot to extend the duration of regular benefits, from roughly 39, 40 weeks to 78 to 80 weeks, provided that certain levels of unemployment within the state. And we'll have to see where that goes, because Congress is actually not going to be in session a whole lot before Labor Day. And so the challenge is actually going to be getting people to build a consensus in the short amount of time that they're going to be up there. But some data that popped up over the weekend related to the risk of a second wave, or shutdowns related to a second wave, and the OECD, which is the Organization for Economic Cooperation and Development, a large multinational body that does predictions of this sort. They forecasted that if the U.S. they forecasted the U.S. unemployment rate of 12.9% at the end of this year if we get hit with a second wave of lockdowns. And that compares with 11.5% if there's no lockdown. Next year, if there's a lockdown, they predict a unemployment rate of 11.3%, and without a lockdown, they're predicting a rate of 8.5%. So obviously, the more significant gains in unemployment would be had if we could avoid that second lockdown. So I thought that was kind of interesting, and some tidbits coming to us from Sandy Leeds in some of his weekly work. We saw used vehicle sales drop 38% in April, but in June, used car sales rose 17%, and a survey of 50 healthcare executives and investors showed that nearly all expect the vaccine will eventually be approved in the U.S. More than half believe it will happen late this year or in the first quarter of 2021. And approximately 40% of the respondents of this particular survey expect the vaccine to be available to all by late 2021, while 36% are expecting that until 2022. So again, a lot of optimism being, I would say, definitely priced into the market related to the prospects of a vaccine development near term. But clearly, healthcare executives and investors that are surveyed don't expect that to be widely available to all till at least some point mid to late next year. So that will bear watching for sure. And the other just general interest item that I saw, again, one of those issues that I didn't mention in some of the risk factors, but clearly exists, is the whole U.S.-China issue, the trade spat, and the fact that the first round of trade negotiations and that agreement may not, in fact, be adhered to, and that we might be finding ourselves in a very deep and prolonged trade war with China. But they're nearly, from Sandy again, 370,000 Chinese students enrolled at U.S. higher education institutions last academic year, and they comprise 34% of all foreign students. And to put dollars around this, that Chinese students account for roughly $15 billion of education spend per year. So if you tell Chinese students, no, you're not welcome anymore, obviously that's going to have an impact, as will likely be the case with the pronouncement that international students will not be welcome in the U.S. If schools go to online. And obviously there's a lawsuit now by, I believe, Harvard and Yale on that very issue. So lots of fluid information, but from a market standpoint, clearly second quarter earnings are going to be up, and as we talk about this in our market meeting, or excuse me, market minutes over the next several weeks, we'll be giving you updates on how those trends are developing. So we can all hope that we see companies be good stewards of the capital that they've been raising and good stewards of what capital they have left, and that they're all preparing for the unknown that we just can't put our finger on right now. Comments that you may have at the information that you see on your screen, and we hope you will be safe. Hope you'll be well, wear your mask, and we will see you next week. Have a great week.